this was a stock that I bought all the way back. I mean, this was back in I think 1984.
Mm-hmm.
And you can see this stock actually had already made a move. I mean, it came up from $5 or $6 a share up to 17, and then it put in this long base for a number. Yeah, look at the move that thing has made. Now, see, that has already had a 3-for-1 split and a 3-for-2 split. This was a turnaround situation. It used to be called Wards all the way going back in the 80s, changed the name to Circuit City, and was the competitor to Best Buy. And so you can see a beautiful cup and handle that the stock made, and relative strength line going into new high ground, right as the stock was going to new high ground. And the other thing to notice is you see the down in the volume, how the average daily volume was drifting off, coming off. It actually looked like it had dropped in half during that consolidation, as the stock was building a base, and that's what you want to see. And then the 3 tight weeks that it had right before it broke out, that's I'm always keying off of that.
Mm-hmm.
So, and that's where well, there you can see the buy right there at right above 16. The first day it looks like it broke out and it finished half range, middle of the range, or even the lower range, but then it continued out, pulled back, and then look at the move that it made. I mean, that's a 16 to 29 move, so you get a 50% move out of that stock. I didn't sell it into strength, but it looks like I sold it right when that thing broke the 50-day moving average. So I still got a 16 to 24 move. So that was still a 50%, 50% move on that stock.
And this is
And
pretty
what
quick.
about
This is not like a 18-month move like for a lot of
No.
leaders. This is very quick. So were you kind of doing these quicker trades and kind of compounding that way for your investing championship?
Because then I would take that and I would move it into another stock, or I'd have another one at that same time. But when a stock is doing this, that's where you want to hit it hard. And you can really have another buy spot there at 1850, where it pulled back right down to that 50-day moving average, and the volume was lighter. And then look at the volume come into that stock as it started moving back up and out.
Now, I mean, that was a pretty big going from 22 back down to 1850.
Yeah.
1850, right?
That's,
You know,
that's
and a number
20%
of
in just
people,
a few days, right?
yeah, a number of people might get shaken out there. What would you say to that kind of scenario?
Well, I mean, it had one day of volume, and it was still above the 50-day moving average. You know, to have any big winner, you have to give it some room. If you are selling it every 10% drop in a stock, or even a 15% drop in a stock, you're never going to have a big winner, because they're all going to do that at one point or another, and then it's hard to get back into it.
Mm-hmm. And is this what was your position size at the time? Do you remember? Were you doing that kind of for?
Yeah, I know.
for the
I'm pretty
position
sure
size?
it was at least a 20% position, if not bigger. So I
Mhm.
would start my position sizers higher. You have to start higher to do that.
Mm-hmm. And this is what that looks like on the weekly chart. You want to discuss a little bit about Franklin Resources?
Yeah, Franklin Resources. Here's another one where the stock had gone from 10 to 30, built a base, and this was just one of the companies that were the forefront of mutual funds. And but I said this. I think I said this a number of times. Lots of times, I just let the market tell me which are the strongest stocks. I watch to see which stocks can double. I look to see them build a new base, and I get the next double out of them if I hadn't gotten them before. But here's a stock that had a really nice move, and then actually even split, but then put in a nice, that looks like a 5 to 6 week base, and all the volume. Look at the volume all along that move. And even when it pulled back for just a couple of weeks in the base that I bought, that the volume was below average weekly volume on that situation.
And
So
I mean, that's
David,
just
when
such a
you were
telltale sign when you see all of that volume come in. When the
Yeah.
moving average line, goes up that much on the move up, that institutions are getting in there. So yeah, what were you going to say, Arusha?
Yeah, when you were trading in the U.S. Investing Championship, what were the type of position sizes you were taking at that point?
Yeah, it
You
was
remember?
anywhere from 20% or even for a short period of time, maybe even 40% when a stock was just going through an incredible run. But they were all big. It wasn't a 5% position. It was starting at 10, quickly going to a 20, and then just managing the trade as it got extended, maybe cutting back, waiting for a new base, and then going again. So this is one that I actually just took the gain after, because look at how many days that was, probably 8 or 9 days that it went from 30 to 40, a 33% move. Went ahead and took that, and I was very fortunate because I think the next day the Wall Street Journal came out with a herd on the street column.
Oh, geez.
Wow.
Bashing the stock, and you see what
Uh-huh.
happened. The thing dropped from 40 down to 30, and then I just sat and I waited for it to settle down, volume to dry up, and you can see the average daily volume drops again, and then starts coming on. Look at the average daily volume during that time, 8,000 shares. I mean, that's when, before the market had its big, huge, well, that was part of the start of the big bull market. But anyway, you see the downtrend line and the break of the downtrend, and there it is again, going up on some really nice volume. So back into the stock again. So you can play these things multiple times.
Mm-hmm. And for those folks that are maybe listening to this and are missing out on the charts, remember you can always go to investors.com/podcast to see the charts that David Ryan is talking about. Unfortunately, these are charts that we can't pull up in MarketSmith anymore because these companies no longer exist sometimes. So that's why we're using these charts from older and other areas. But yeah, it looks like you waited and bought this one again.
Right, and had another great move. Yeah, see, look how so then it goes from 20, and then I guess I added to it again at 30, and now this is split adjusted, I guess, and then it has another move to 50. And when you see something going up at that rate, that usually is a blowout, a climactic run, and I think I waited for the first stalling day to start selling some of the position, and then I sold the rest of the position later as it started breaking down. Sometimes it's hard when you've made so much money on a stock, or it starts becoming like you're a child, and you just can't lose it. You can't get rid of it, and you want to hold on to it. And I guess that's why I stayed in until it actually broke that little base right below 46, I guess.
So sometimes it looks like when you were going through your notes, you'll do a little post analysis, and here's an example of some post analysis notes that you wrote on a couple charts that you had.
Yeah, this is all we had back then. Everything was a printed copy, and so so this is where I lost money on Dress Barn. Back, I guess it's 1986, where I thought I was buying a breakout, and it looks like it broke out for a day or two, and then it pulled right back in. And I think what I was doing is that the position sizing, even to this start, was too big. That's why I said way too big under market conditions. So the market might not be in the greatest of shape. This stock really, I mean, that's when I look at that, I go, what was I thinking? That base just does not, even the move up from 20 to 25, it looks like 3 moves into a top, and then it just quickly rolled over. The same thing on this New World Pictures. You're only seeing you really didn't see the rest of that base, but I guess I bought it as it was coming out of 22, and once it dropped right back into the base, then I sold the position, but I think I bought that too big right at the beginning. So but these are things that you should be doing. You should be printing out these charts when you're buying them or when you're selling. Do a post analysis, because boy, that will reveal more. You'll learn more about yourself, your trading habits, and your mistakes than anything that anybody can tell you, because you know why you're making these decisions, and it's best to really study your own actions in the market.
Do you
So-
remember what position size you were going with starting up with those things?
I don't. I don't know, but I see 5,000 shares at 20. That's 100,000 shares. I mean, if my an 85. I mean that sounds like a 20% position at that time.
And so, for both of these, you're saying that it was too big under market conditions. So
Yeah.
do you scale back your position size depending on your feelings on the market strength?
Yeah, if the market is, if I'm not getting good feedback from maybe other stocks I own or the market in general, or I just can't find that many names, then I shouldn't be starting out as a 20% position right off the bat. I should start scaling. It should be more 10, then 15, then to 20, but not that big all at once.
Right. And speaking of kind of getting that big all at once, is this something that when someone's just starting out, should they kind of use this methodology, or is this something that you want to kind of work your way into? What's kind of the best thing for beginners?
Yeah, that's a good way. If you're just starting out, you shouldn't be doing this, and you shouldn't be buying in size right off the bat, because you're going to make a lot of mistakes in your first 2 years, your first up market and down market. And so it's best to, I've even said, take 90% of your money, put it in T-bills, use the 10% that you've got, because you're going to make a lot of mistakes even on that 10%, and it's better to do it on a small amount of money than all your capital. Once you get the experience, once you start having success, then you start adding more money to the market.
Yeah. And you kind of mentioned that, when you were younger, you were a little bit of a gunslinger. Now that you don't need to use margin now, it's not like you're trying to, make the big bucks. You've kind of a lot of times kind of trying to keep what you have. So have you shifted this to more positions, smaller position sizes, or how have you adjusted?
Yeah, more positions. Now the capital I'm working with now, I'm going to 10 positions, but even some of those, when they start working and they're doing well, then that's not going to be a 10% position. With appreciation and buying additional bases, they can get up to 20 or 25% of the portfolio with something that's been working.
And we've got one more thing that, as you were doing research, that you came up with that you wanted to share. So go ahead and tell us what we're looking at here.
Yeah, and this, so I had to go back when and look at my tax returns for these years when I was winning these U.S. investing championships, and I looked at what I was being paid at O'Neill and the capital gains I was making. And so you can see in 85, my salary was 25,000, but my capital gains were 52,000 in the market. And then the next year, I guess I got a raise. I was making 34,000, but I had capital gains of 255,000. So that was almost 7 times what I was being paid. And then the next year I was up to 58,000, and my capital gains were 449,000, which was almost 8 times or so. But but this is where I was using margin. I was using concentration, and you can see the power of the compounding when you can do this, a number of years in a row. It's just amazing how big the numbers can get.
Yeah, and let's not forget 1987. That's when the big crash happened. So
Right.
It looks like you were able to retain a lot of gains if at the end of the year, at the end of the tax year, you still had that sizable capital gain that you were looking at.
I still remember August of 87. I got married, and during my honeymoon, the market was up. But right as I came back, it looked like the market had topped out. It had one last move in October, but there wasn't anything that was working. And then it just rolled over and died. But I was out long before the crash. The market had topped in August and it crashed in October.
And were these years your U.S. investing championship years too?
Yes. Yeah.
So, because I know you had a number of back-to-back years where you won the investing championship, and were you using this position size of roughly 20-25%?
Oh yeah. This is where I was really aggressive on the position sizing and also use of margin.